Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, Shiraz Mian here with the Zacks top picks video, our weekly video series. Joining me today will be Andrew Rocco. The stock I have picked is a blue chip stock that is good for any market, but particularly well situated for the times we are living in. And the stock is 3M. 3M has been under a cloud for a while. A bunch of issues with it, the complexity of its operations, a bunch of litigation issues. But the company seems to be putting all of those things behind it. And here I'm showing 3M relative to the S&P 500 and the Zacks industrial sector. You could call 3M a conglomerate or an industrial player. It serves a variety of end markets. So you could see here 3M is outperforming in this 1 year performance relative to the S&P, which is the green line, and the industrials, which is the red line. But if you take a longer view of the stock, which is what I'm doing in this chart, which is a 3-year relative performance, you could see that the stock still has been a laggard relative to both of those benchmarks. And that's the primary reason why I'm recommending it. It's a blue chip stock. New management, in fact, I should point out, is doing and taking a number of steps that's putting all of the headwinds behind it and in making it once again the blue chip outperformer that it has always been. So it has had a good run as we saw in the previous chart, but there's still plenty that the stock has to reclaim. So I'm calling this repositioning of 3M as a back to the basics story. Management is trying to simplify the spider's nest of operating structure that it had morphed into over the years, streamlining operations, getting out of fringe and non-core products, simplifying and optimizing supply chains. And all of that may sound as a bunch of fluffy buzzwords, but they have net effect not only on the company's growth profile, but also margins and working capital and balance sheet strength. A very diversified player, 3M is, both in terms of its geographic footprint and the end-use markets that the company serves. Safety and industrial, about half of total revenues. Transportation and electronics, about a third. Consumer and market, about a fifth of the total. They are getting back to their knitting, refocusing on R&D, and getting back to the fortress balance sheet that they have always been famous for. Returning excess cash to shareholders through buybacks and dividend. The dividend is north of 2%. On the risk side, or the remaining clouds on the horizon, the PFAS, the so-called forever chemicals litigation, remains an issue. The earplug questions have been addressed. But those are some of the things on the risk side that you have to keep in mind of. In terms of valuation relative to the forward 12-month consensus estimates, is trading at 16.4 times. Significant discount to the market. As you could see, the red line is the S&P 500. This is a 10-year span. The shaded area in the middle is the COVID recession. And you could see that the stock consistently traded at a premium to the market prior to COVID and has been a laggard ever since. And my core thesis, as I laid out at the beginning, that that this 3M is on course to get back to its premium valuation, premium trading status, and we are just at the beginning of that, of that movement back to the normal. So this is the same chart as we showed earlier. It just shows the 3M PE multiple as a ratio of the S&P 500 multiple. At the bottom of this chart is the numerical values for this 10-year period. It's currently trading at 81% of the market multiple. It has traded historically over this 10-year span as high as 138%, meaning at a 38% premium, and as low as 44% of the market, which is right around here late last year, with a median over this 10-year span of 99%. So roughly about the same as the market. So it's currently trading at a 20% discount to its historical trading median. And I strongly believe that if you have the holding horizon, some exposure to this name that has been left out as one of those former glory blue chips that have fallen on hard times, 3M is definitely on course to reclaim its premium perch. And I believe the journey has gotten underway already. And you could look at the stock's behavior over the last 2 weeks when everything was in turmoil. It held its ground, and I strongly believe that irrespective of the market conditions in the back half of the year and next year, this stock will move into further strength and momentum. So a strong long-term core recommendation for your portfolio, 3M. With that, I'll pass it on to Andrew.
Thank you so much, Shiraz, and welcome everyone. My name's Andrew Rocco. In case you don't know me, I'm a stock strategist here at Zacks Investment Research. I also do manage the Tech Innovators portfolio. Today, I'm going to discuss my top stock for the week of August 5th. So let's jump right into it. So my top stock is a Zacks ranked number 1, the best possible Zacks rank, strong buy stock, and it's Intuitive Surgical, ISRG. And Intuitive Surgical is a company known for its expertise in creating and producing cutting-edge robotic-assisted systems. Their primary offering, the Vinci surgical system, is crafted to enhance surgeons' precision, control, and skillfulness during procedures. This innovative system enables surgeons to conduct surgeries through openings by maneuvering robotic arms from a central console. So this machine that they have, it actually goes from anywhere from $500,000 to $1 million. So it's a very complex system, and a doctor still does operate the surgical system, but I'm going to get into a little bit of what makes this company so unique, why this product is so hard to replicate, and why that's going to make the stock continue to go higher than it already has. So let's jump into the Da Vinci system itself. I call it the ultimate moat, and I'm going to describe why. First of all, Intuitive Surgical has been a pioneer in robotic-assisted surgery. So we hear a lot about robotics and AI right now, but these guys have been doing it consistently since 1999. So they have a head start, especially in this space. It's kind of a niche space, the robotic surgery space. Obviously, it's very hard to break into from a regulatory aspect. So they have all the regulatory approvals. They've jumped over that red tape. So even if you were to make a machine that is comparable to Intuitive Surgical's, you'd still have to get all of those regulatory approvals. And as I'm going to discuss later, Intuitive Surgical, they keep making their system better and better. ISRG, they also have an established reputation and trust. Over the years, the Da Vinci system has built a strong reputation for safety, efficacy, and reliability. Hospitals, surgeons, and patients trust the brand, which is crucial in the healthcare sector where the stakes are obviously very high. And they have an extensive installed base. So with thousands of systems installed globally, Intuitive Surgical benefits from a large installed base. This not only generates recurring revenue through the sale of instruments and accessories, but also makes switching costs high for hospitals. So it's almost like an iPhone. Once you have an iPhone, you get the AirPods, you're kind of built into this ecosystem, and that's the kind of moat we want to look for. For example, NVIDIA, they make the strongest AI chips. I don't think anyone argues that. They have their moat. So Intuitive Surgical, what I like about them is they're a little bit lesser known than an NVIDIA or an Apple, but they are selling this product with this very, very impressive moat. And then finally, the training and support infrastructure. In order to install these in hospitals, you can't just give it to a doctor and then walk away. You need a team, that infrastructure to build this out, to teach the surgeons how to use the product. And as I said, Intuitive Surgical already has that going for them. Now, let's talk about kind of a macro tailwind for this company, and that has to do with the aging population that we're seeing in the United States and really globally. For the first time in U.S. history, older adults are projected to outnumber children by 2034. And this is via United States Census Bureau, so it's good info. And typically, obviously, as we age up, getting into my mid-30s here, your body starts to break down, especially when you really get up there in age. Surgery just becomes a part of life, unfortunately. Again, this is going to be something that the Da Vinci system and Intuitive Surgical will benefit from them. And they offer a wide spectrum of surgical procedures. For example, you can get a general surgery such as a colon resection. They do urology, coronary artery bypass, heart surgery, head and neck surgery. So all of these things start to happen to us as we age, and a main beneficiary is going to be Intuitive Surgical. It's going to do a better job with these surgeries. It's at a lower risk, so it's going to be better for patient, doctor, and obviously what we're looking for is, as shareholders, that's going to drive EPS. But just to give you an idea of how dominant they have been, I mean, look at this EPS history. It's hard to find a more steady grower. This is what we call hockey stick growth. Since they went public in the early 2000s, you can see this EPS has been straight up, aside from that blip, obviously, during the coronavirus period, where you can see that growth right up, and we're hitting new highs. And again, this aging population and these demographics are only going to add to their earnings. They're really the dominant player in this unique niche of a space that obviously is not something that we have a choice over. It's something that we're going to need going forward. So let's look into the technicals a bit. Obviously, the market has pulled back. We're seeing a little bit of a rebound in the last couple of days. But when I made this slide, showed the S&P was down 6.8% for the month, and Intuitive Surgical is actually up on the month. And that's what I like to do when the market goes down, because 75% of stocks tend to follow the market direction. So when the market is going down, I like to look for which stocks are the tennis balls, which stocks are going to bounce rather than crack like an egg. So most stocks are going to crack like an egg. The market, we want to look for the tennis balls, because when the market regains its footing, it's those leaders have held up the best that tend to outperform, and it's hard to find a better stock in the market has held up better. I mean, unless you're shorting something, as far as the long side goes, ISRG is upward the hunt, which is very, very impressive in this volatile market environment. And again, once that market pressure is alleviated, I expect stuff like this to really outperform here. And not only are their earnings very, very strong, ISRG had delivered 6 straight quarters of positive EPS rises above the street, above the Zacks consensus estimates, have above the follow. Meanwhile, since its IPO in 1999, the company has been one of the steadiest growers in the market. Not only does it make important updates to the Vinci surgical tool, it also has a recurring revenue source from that ecosystem that we talked about. And it has various different instruments out of for this Da Vinci system. The company currently offers approximately 70 different multi-port Da Vinci instruments to provide surgeons with flexibility in choosing the types of tools needed to perform a particular surgery. So you have this big machine, and then you have all of these add-on products for these specific surgeries, or to kind of customize it for that particular surgeon. So really impressive product offering. And let's talk about how the macro environment might benefit these healthcare stocks. At this juncture, lower rates are pretty much a given. Right here, you're seeing the CME Fed Watch tool. It gives us 100% chance of a rate cut in September. I don't think anyone is arguing that at this point. And with the worse than expected employment numbers last week, Jerome Powell and the Federal Reserve are almost guaranteed rates. Stocks in the healthcare industry gain advantages from lower interest rates to decreased borrowing expenses and increased investment capital. So again, another positive catalyst. That's not directly related to ISRG, but it's definitely going to act as a tailwind. And then finally, on the ISRG front, as far as the fundamentals go, it is a stealth AI play. We hear a lot about AI right now, but surgical have been utilizing AI in public. And as AI continues to get smarter and smarter, and they find new uses for it, I think ISRG will be a big beneficiary, because it's going to have improved sensing, microfabrication, and molecular imaging, and that's going to enable new approaches. Doctors and surgeons are going to have to even do less, and the surgeries are going to have better outcomes, in my opinion, as they pinpoint that. So again, you don't hear about it as much as an NVIDIA or advanced micro devices, but this is definitely an AI play, and one that I like because it's often overlooked by investors. Back to the technicals real quick. You can see we have a red line on this chart, which is the 50-day moving average, and then the black line down below, that's the 200-day moving average. The S&P and NASDAQ are nearer their 200-day average. The NASDAQ hit that 200-day yesterday, but it's just an idea how about this stock is holding up and it's trending nicely above that 50-day, holds in at support, holds in again, finds buyers. So institutional investors tend to defend leading stocks at the 50-day moving average. That's exactly what we're seeing with Intuitive Surgical. It is a higher price stock. You can see it trade for around $4.50 a share. But I always like to say you get what you pay for. Just like in real life, if you pay up for something, chances are you're going to get more quality. So what's important in the market, obviously, is the percentage move, not the point. So always just remember that. You want to actually gravitate towards these higher price stocks, because that's what the institutional investors tend to gravitate towards. And I just wanted to touch on a few things related to the market, 2 slides related to the market. What you're seeing here is a CNN Fear Greed Index. This combines 7 sentiment indicators to give you this kind of composite indicator, and it goes from extreme fear to extreme greed. What we're seeing is actually the most fearful levels since October of 2023. It actually undercut those levels, and that actually marked the last bottom. So whenever I see the CNN fear greed and extreme fear, it definitely means that typically bounces around the corner in the market, and in the intermediate bottom is here. And then here's the volatility indexes, annual candles. And volatility just means fear in the market. And the VIX printed its 3rd highest level today since 1990, or 3rd highest level earlier in the week on Monday. So over times it was higher. The bottom of the great financial crisis in 2008, as well had the 2020 COVID pandemic. That shows how extreme fear has gotten in the market just on this pullback. It is kind of a garden variety as far as percentage. We're about 10% off in the NASDAQ, and you can just see how much fear there is. And my money is on that. We're going to see an intermediate bottom sooner rather than later. So I did want to just touch on that. There's obviously unusual times in the major indices. But as far as Intuitive Surgical goes, it's a leading innovator of robotic-assisted surgery systems. The company benefits from that aging population, a solid moat, and a great ecosystem. So we are bullish on the stock over the next 6 to 12 months. If you enjoyed today's video, I would tell you to go to Zacks.com/promo to have a promo going on. Once again, thank you all so much for watching. And again, that's Zacks.com/promo. A great week. Thank you.